Bitcoin's price history, as you probably know, is a total roller coaster. But what if I told you that some of its most explosive bull runs are actually triggered by a predictable, pre-programmed event? Today, we're diving into the Bitcoin halving, the built-in code that has, time and again, sent its value soaring.
So, what's the secret sauce here? What's the one thing that has historically kicked off every single major bull market for Bitcoin? It's not some random market fluke or a crazy news headline.
The answer, believe it or not, is literally built right into Bitcoin's DNA. It's a mechanism called the halving, and it's an automatic, scheduled event designed to control its supply. It basically just makes new Bitcoins harder to create over time. Let's see how that's played out.
To really get this, we have to go all the way back to the beginning. The very first halving in 2012 was the ultimate test case. This was the moment a wild economic theory was basically unleashed into the real world.
Okay, so here's what happened. Every 10 minutes or so, a new block of transactions is added to the network, and the miners who do that work get a reward. Before 2012, that reward was 50 Bitcoin. Then the halving happened, and bam, it instantly got slashed to 25. Just like that, overnight, the rate of new Bitcoin creation was cut in half.
And the impact on the price? It was immediate, and it was absolutely dramatic. Before the halving, Bitcoin was trading for about 12 bucks. A year later, as you can see, it smashed right through the $1,000 mark for the first time ever. That's a mind-blowing increase of over 8,000%.
So why? What caused this? It was pretty much economics 101. You had this new, hard-coded scarcity, that sudden reduction in new supply, and it collided with this small but growing wave of curiosity from early adopters. For the very first time, the world got to see programmed scarcity in action.
Now look, one time could just be a fluke, right? But what happened next? Well, it really started to look like a pattern. Let's jump ahead to the next two halvings and see how this thing really builds.
So fast forward to 2016. The code executes again, like clockwork, right on schedule. The block reward gets sliced in half, dropping from 25 Bitcoin all the way down to 12.5. The supply of new coins was tightening up once again.
And just look at what happened to the price. Before this event, Bitcoin was hovering around $650. 18 months later, it famously skyrocketed to nearly $20,000. The pattern wasn't just repeating, it was getting way more explosive, both in price and in global attention.
This cycle was different, though. It wasn't just the early tech heads anymore. This was driven by a full-blown global retail frenzy. It was fueled by the whole initial coin offering or ICO boom, where new crypto projects were raising insane amounts of money, and just an explosion in mainstream media coverage. Suddenly, everyone seemed to know about Bitcoin.
Then came 2020. The market was way more mature by this point, but the code is the code. It doesn't care. The reward was halved again, this time dropping from 12.5 Bitcoin per block to just 6.25.
Now, the starting price was already pretty high at almost $9,000, but the pattern? It held. Bitcoin soared to its current all-time high of $69,000 in the following year. Even with a much, much bigger market, the supply shock still seemed to have a massive effect.
And here's the crucial part. The driver changed again. This cycle wasn't really about retail anymore. It was defined by the arrival of the institutions. We're talking major corporations like MicroStrategy and Tesla putting Bitcoin on their balance sheets, hedge funds jumping into the space, and PayPal bringing crypto to millions. The big money had officially arrived.
Okay, let's just pause for a second and look at this table, because it lays it all out so clearly. You can see the progression, right? 2012 was all about the early adopters. 2016 was a massive retail frenzy, and 2020 was the institutional entry. Three totally different market phases, three very different groups of people, but the same fundamental result, a supply shock followed by a new all-time high.
Which of course brings us to today, the cycle we find ourselves in right now. Because in April of 2024, the fourth halving happened, kicking off this current chapter.
This timeline really helps put it all in perspective. You can see we've been through 3 of these 4-year cycles, and there we are, the "You Are Here" sign right at the start of the 4th. The next one's already penciled in for 2028. It's a remarkably consistent schedule, you have to admit. So what does this actually mean for today? Well, the block reward is now a tiny 3.125 Bitcoin. If history is any guide at all, we are right now in what's called the accumulation phase, that period after the halving but before any potential major price surge. The market is watching really closely, and a lot of people are expecting an energy similar to what we saw back in late 2020 and early 2021.
With this pattern so clearly laid out, it naturally makes you wonder, right? What could the next cycle, the one starting around 2028, even look like?
Well, the market just keeps evolving. The next cycle could be shaped by even more institutional money. We're talking pension funds, maybe even sovereign wealth funds. We could see Bitcoin truly cement its place as a global macro asset, kind of like a digital gold. And that might lead to a bull cycle that's deeper and maybe even a little more stable than what we've seen before.
And it all comes back to this one simple but incredibly powerful idea: programmed scarcity. Every 4 years, like clockwork, the creation of new Bitcoin gets cut in half. So if demand for it continues to grow, or even just stays the same, this recurring supply shock has historically made the existing coins more valuable. That's it. That's the core principle driving this entire thing.
So, that leaves us with the big question, doesn't it? Each cycle, the market has gotten more mature, and the players involved have gotten way, way bigger. We've gone from a few early hobbyists to global corporations. So with the stakes higher than they have ever been, will this 4-year pattern of programmed scarcity continue to drive the market? Well, only time will tell.
Subscribe and visit Web3 Newswire for visibility and credibility of your Web3 projects.